Tom, the bulls are dropping like flies on all this volatility and increased recession probability around trade tensions. I believe you're still hanging in there, saying
yes,
bye.
I mean, we're at the ledge, and, it looks like it's scary, but I think we're mid-cycle. So I think if the economy's mid-cycle, and I think we're getting a lot of confirmation from how high yield is near all-time highs and August highs, I just think this is a buyable pullback, and it's a scary time, but I think investors need to have faith.
Why are you saying we're mid-cycle when everybody else is saying we're late cycle?
Well, I think that one of the things convincing people that we're late cycle is the inversion of the 10-2, right? Or really the entire curve is kind of inverted. But most inversions occur because the Fed's tightening. These inversions are taking place because the long end is actually plunging. So this has been a risk-off inversion. More importantly, capital spending, if you look at total private spending, is kind of mid-cycle today. It's around 24% of GDP.
David, what are your thoughts at this point? I'm curious as to whether you happen to see this editorial from former New York Fed Chairman Dudley, sort of basically saying, the Fed's accommodation could encourage the president to escalate the trade war further, kind of encouraging to decouple from that.
It's what psychologists call enabling. It is I think that is problematic for the Fed. The Fed has to deal with the economy they have, but it's clear, the fact that the president increased tariffs the day after the last Fed cut does suggest that if he gets easier monetary policy, he feels that's licensed to be tougher on trade policy. I'm not sure that's a recipe that's going to work very well for the economy. But still, it's for the market, the key thing is that rates are so low that it is funneling money still towards equities. And it's very hard for the equity market, I think, to crash when yields and 10-year bonds are 150. I mean, you just don't get value anywhere in the fixed income world. And I think that is keeping the market in here, even though there are some troubling signs for the economy overall.
What are those troubling signs?
Well, I think this is really much more a matter of business confidence and consumer confidence. I mean, the consumer confidence numbers sound very good, but I think the problem with business confidence is not so much confidence as uncertainty. And I think this back and forth in the trade war is causing business uncertainty that tends to cause them to pull back on capital spending and pull back on hiring. And by the way, hiring is twice as cyclical as layoffs. So hiring is really the thing that we worry about. If companies stop hiring because they're uncertain, that can put a damper on the economy. But still, I don't even know you can call this late cycle because the economy's been evolving so much that this is not a typical cycle at all. I think the economy probably has some room to run here, but at a slow pace.
So, Tom, within your overall sort of optimistic view of where we are on the economy, how do you read into the fact that cyclical stocks have underperformed so much, especially in the month of August? Leading stocks like transports and the Russell you can look at and auto stocks. I mean, take your pick.
Yeah, I mean, these are all going to be victims of trade tensions, and I do think global economic conditions are really slow. So we have a growth recession globally, and, let's face it, I think parts of Europe are probably in recession. So I'm not surprised cyclicals are weak, but does this mean that the whole economy has to roll over and equities have to roll over? I don't think so. I think the key to watch is, look, if high yield is trading at all-time highs and spreads remain tight, that's a market that's not telling us we're late cycle.